of measuring national income. How does the government of a country measure what? National what? Income. How does the government calculate the total amount of goods and services produced in the economy in a particular what? Period? We have three approaches or three methods of measuring national income. We have what? Three approaches or three methods of what? Measuring national what? Income. We have the value added method, or we can call it the output approach or the product what? Approach. You simply mean the same thing. Either you call it the value added method or approach. You can call it the output approach or method, or the production what? Approach. So look at it. Either you call it value added, or you can simply also call it as what? Output approach. Or you can call it product approach. They simply mean what? The same thing. So if you like, you call it output or product, they simply mean what? The same thing. So we have the value added approach, product approach, or output approach. We have the income approach or the income approach method. Then we have the expenditure what? Method. These are the three methods of measuring national income: the value added approach, the income approach, and the expenditure what? Approach. So with these three methods, if one computer, the three of them will give you the same what? Answer. So let's take a look at each of these methods. What do they entail? And then we have the output and or product approach, as I have earlier stated, income approach and expenditure approach. Then the output or product approach, that is the value added approach. Let's discuss it. I want to talk about the value added approach or the product approach. This measures the total output of goods and services produced within a country in a particular year. The output approach measures the what? Volume of goods and services produced in a country. So what this method is simply to calculate all the amount of goods and services produced within our economy. That's what output or what? Product. So this one specifically what? Measure what? Product. Output of goods and services produced. That's what the value added approach actually what does. It measures the what? Amount of goods and services produced. And this method, what do they call it? The value added approach. Why is it called the value added approach? It's called the value added approach because it measures only final goods and services produced. You only measure only what? Final goods. That's why it's value added. They don't measure intermediary goods, that is semi-finished products that are used by other what? Company. It does not record the what? Raw material. What is only recorded is the what? Value added, which is the what? Final what? Goods. That's why I also call value added what? Approach. It's measured the what? Final what? Goods produced within an economy. Then there are some problems or difficulty in using what? The value added approach or the what? Output what? Approach. One is what? Difficulty in computing. Another one is double counting. Also we have what? Omission of what? Unpaid what? Services. These are some of the difficulty encountered using the what? Output what? Approach. Before we start looking at each of these difficulty, let's look at what the output approach actually means. That the output approach is make sure the what? The goods and services produced in our what? Economy, the monetary value of goods and services what? Produced. For the teaching I'm teaching, what is the monetary value of it? How much am I paid for teaching you? That the monetary value of the goods produced. That's what the output approach measure. What is the monetary value of goods and services produced? And some of the limitations we have what? Difficulty in computing, double counting, unpaid what? Services. Let's look at each of them. Difficulty in computing. There is difficulty in computing the proportion of output consumed in the production process. So this difficulty in computing the proportion of output consumed in the production process. If, for example, I'm into production of bread, I have a bakery, and you know the output approach measure the monetary value of goods produced. And during the process I am producing bread, I give my workers total loaf of bread to consume, total loaf of bread during the working hours. Now, the output approach will not what? computed, this one, because they are consumed in the production process. So these ones are not captured in the what output what approach. So this is one difficulty or one limitation of the output what approach, that there is difficulty in computing because some of the what item consumed or some of the products consumed during the production process are not what captured by this what method. A farmer that is into that harvest his products before it to get to market during the process of harvest farming, some of the products are consumed by the farmer. So those products are not captured in the what output what approach. Those that are consumed during the process of what production. It only captures the what final goods and services what consumed or produced rather. Final goods and services what produced. But those that are being used up in the production process, it's not captured by this what approach. So it's a big limitation. Another limitation is that there's a problem of double counting or the possibility of what double counting. This method, there's high probability that there is a what high risk of what double counting. What has been counted before can be counted again. What has been counted before can be what counted what again. For example, look at, let's say this is a cattle farmer is into a dairy cattle producing milk. The output of this farmer will be counted, isn't it? By the goods and services produced. So this farmer would produce what milk, extracted milk from the cow. So what will be counted is the quantity of milk extracted. Now he sell this milk to a factory that is into what production of what milk, processing milk and canning milk. Now this milk that has counted before, this they will now be counted again. Yeah, they will count it what 2 times. They count it to the farmer. That's the goods produced by the farmer. Now this milk company, after they have processed it, after they have canned it, it will also be counted for this company again, that this company produced milk. Now what happened now? They have counted the milk twice. They counted it what twice. From as a is the output of this company. And if you come back to this side now, it's now become what an input or a raw material to this what company. So we have counted it what twice. That's why it's very important that in this method, what is counted called the value added. What will be the right thing to do is to count only the value added into the what production process. So what we do, they will count the milk here, the quantity of milk here, which is the output in terms of monetary value. Now, when they bring it down to this company to process, what they will simply do, they will not calculate the milk again. They will not count the value that has been added to the what milk by processing and canning it. So this problem, there's high risk of what double counting. What is a finished product in one industry, it can be a raw material in another what industry. So if we count the finished product for that industry and we now come to another industry that finished product is a raw material and we also count it, that we have what counted the commodity what twice. So this is another problem with what the output what approach. Then we have another problem with this or limitation using the output approach. There's omission of unpaid services. Omission of what? Unpaid services. In developing countries like Nigeria, there is a large non-monetized sector economic services. There's a large non-monetized sector economic services that are not paid for in terms of money. What we simply mean here is that in developing countries, there are some services that are rendered that are not actually paid for, but in recent, economically, they are also be paid for. An example is the service of housewife. Let's take a typical look of the service of a housewife. A housewife, economically, is somebody that is married but does not take part in production processes. He sits at home and do the home chores. Now look at this person that is sitting at home and does the home chores. She do the cooking. She do the apart from cooking, she also take care of the family and other home activities. Now this person, this housewife is not paid, which implies that if the person is being paid before, it will increase the output approach. It will increase the national income because that money that is being paid to the person will be calculated. But let's look at another scenario. In the place of the housewife, they now employ a house help and a nanny. They employ what? A house help and a nanny. The house help will be paid, isn't it? And the nanny will also be what? Paid. So if we look at this output approach, there are some services that are what? Not paid for. Services that like probably somebody, a man working for his father-in-law. for free. Those services are not what paid for, and such a situation it will now reduce the amount of what national income, because those items are not what recorded. So there's another limitation with the what output approach, because it does not capture omission unpaid services. Unpaid services does not capture it. It does not capture also items that are being consumed in the production was process, and also there's a probability of what double counting. What has been counted in another in a industry can be counted in another what industry. So that is what some of the limitation of the output approach. Then we have the income approach. The income what approach. This method take into account all the income earned by all the factors of what production. This method take into account the income earned by the factors of what production. I've told you that we have the factors of production are land, labor, capital, and entrepreneur. These are the factors of what production. And for land, you pay rent for land. For labor, you pay what wages and salary. For entrepreneur, his return is what profit. And for capital, the return for capital is what interest. So what this approach simply does, it calculates the what income received by the what factors of what production, and it sums them together to get the what national what income. So how much is being received by land? All the land. Now, what is the rentage paid for land in the entire country? What is the what? The salary and wages of laborers in this country? What is the profit of all the business enterprise in the country? And what is the interest for what capital invested into a business? So when you sum all of that together, it will give you the what national income using the what income what approach. So now let's look at some of the limitations in the income approach. Some of the what limitation in the income approach. One of them is that retain profit, underground economy, inaccurate income record, self-occupied what property. So now we'll take a look at each of them. We'll take a look at what each of them. Let's look at retain profit. Retain profit is the part of profit of a business that is not shared among its shareholders. What about retain profit? A part of the profit of a business that is that is not shared. If, for example, in the class, let's assume 10 of us come together in Susu College and we form a business, and the business we are being paid, we make a profit of 20,000, let's say 20 million naira, and at the end of the day we share with Sokori for the 20 million naira profit we made. Let us just share 5 million among ourselves. Let us put the remaining 5 million into the business, the remaining 15 million naira into the business. That 15 million that we put back into the business is called retain what profit. The business retain the profit, is not shared among the what shareholder. So if they are computing national income now, instead of them to compute 20 million naira in terms of the profit of an entrepreneur, what will be computed will be the 5 million naira that is shared. That 15 million naira will not be counted because it was not shared as what profit. So it's what retain what profit. By so doing, the national income statement will what reduce. It will reduce by what 15 million. So this is one of the problem with all limitation of the what income approach. When profits are retained in a business, the income approach does not have the ability of capturing that what profit. Another one is what underground economy. Underground what economy. When we talk about underground economy, we simply refer to economic activities that are not captured by economic statistics. We talk about economic activities that are not captured by economic what statistics. What it simply means, those things, they do not pass through the right channel, economic channel. Underground economy are those economic activities that do not pass through the right what economic what channel. By so the government cannot be able to what detect those what money are recorded in the national income. For example, you have a brother in USA. He wants to send you money. If he send you the money through the bank, the money will be captured in the national income because it's record. The bank will have a statistics for the data for which they will submit to the National Bureau of Statistics. But this time the brother also brought to send you the money through the bank. What he simply did, he bought a car, and inside the car he puts the money inside the car. So when the money come, when the car arrive Nigeria, what will be the car will be calculated in terms of the monetary value of the car, but the money inside the car, probably you are the one that go to the custom to clear the car. You took the money from the inside the car, probably from the engine or wherever it's hidden. You took the money. That money, the country is not aware of that money. So that money is passed through the underground economy. So any economic activity that does not pass through the right economic channel is referred to as underground economy. Example of such economy again, say drugs. Those people that are into drugs, those people that buy and sell drugs, when it is not captured, like when talk about drugs, talk about hard drugs, when those income is not captured by the economy per se, it does not pass through the right channel, they are referred to as underground economy. And the money that is being made through this underground economy is not captured in the national income accounting, and this will now reduce the value of the national income. So it's another limitation using the income approach. Another limitation of income approach is inaccurate income record. Inaccurate income record. Many people in West Africa are self-employed, hence there are no accurate record of their income. Look at it. That woman that is selling in front of your shop, in front of your house, that woman that is selling food stuff in front of your house, at the end of the year, can you go and tell the woman to give you account of all her profits? She does not keep account. She does not have account. So what does this simply mean? That in a system where where most people are self-employed, they don't keep account. All this little business, small business rather, they don't keep account. So in the national income accounting system, using the income approach, those small businesses, they cannot have accurate information of their profit. So the income approach cannot capture the actual profit. Then this will now lead to other understating the national income. The national income value will be understated because there is no record from this small business enterprises, self-employed persons. Look at this picture here now. Let us assume this is a woman that is selling at a market. This woman does not have an account of her profit per month or per year. So there will be no information for this woman. What the government can simply do, they can only estimate the value that this woman makes 10,000 naira in a month or 300,000 naira in a year. By so doing, the national income will either be understated or overstated. So in a situation there is inaccurate income record, the national income become either overstated or understated. So it's another problem using the income approach. Then one other problem using the income approach is that self-occupied property. When we talk about self-occupied property, the house, let's assume your compound is your father is the owner of your compound, and you people are staying in the compound. You people will not pay rent, isn't it? Let's assume you park out of the compound, and you are staying in another compound that is not possessed, it does not belong to your parents. That compound, your parents will pay rent, isn't it? And your apartment that you left in your family compound now, somebody else will enter, isn't it? And the person will pay rent to your parents. Look at the income approach. Let's say the income approach, make sure the income received by the factor of production. Rent is part of it. So when you are occupying your own property, you don't pay rent, and when you don't pay rent, you will now reduce the value of the national income, because if you have allowed somebody to stay in the property, somebody will be paying rent to you, and by so doing, the national income the value will increase because they are paying rent, which is captured by the income approach. But since you are staying in your own personal property, this is your personal property, you are staying in your personal property now, you don't pay rent, and since you don't pay rent, that value for the rentage will not be captured in the income approach. So that's some of the limitations of the income approach. We say that one of the limitations is that retained profit are not captured, underground economy activities are not captured, and we also have a situation of inaccurate income record. We have self-employed, self-occupied property. People that occupy their property, they don't pay for rent. By so doing, the national income will be understated. Then let's look at the last approach, the expenditure approach. This is the most popular approach and it is used widely. This is most popular approach. This approach measures the total expenditure on goods and services by individuals, firms, and government in a country at a particular time. What the expenditure does to calculate the national income of a country, that is the total amount of money in a country spend or receive. What it simply do, this approach will calculate the total amount of money that is spent by individuals, that is you and I, our household family, by the government, how much the government spent, and how much did private firm or business organization spend. So we calculate the expenditure of individuals, firm, and what government to calculate to get the what national what income. So this is the most popular method of measuring what national what income. And this approach has to do with what expenditure only on final goods and what services. This approach only pay at expenditure on final goods and what services. The formula for calculating expenditure approach, we have to calculate the expenditure approach. The formula is y equal to c plus I plus g plus s minus m. This is the formula for the what expenditure what approach. So this formula is what we use in the expenditure approach, that the national income is equal to consumption expenditure plus investment expenditure plus government expenditure plus net income from abroad. What will simply mean, let me go back. Okay, what will simply, the formula says that y stands for national income is equal to c consumption expenditure, that is consumption expenditure, how much did your parents, the family, spend. Then investment expenditure, how much did business enterprises, how much did they spend, they invest in their business, that is investment expenditure. Then we have government expenditure, how much did the government spend in a year. So when they add all this expenditure together, we give you all the expenditure approach. Then you have net income from abroad, how much did the country receive from exporting their goods, you add it, then you subtract the what money you receive, you spend on what importation. So this is what the expenditure approach is equal to consumption expenditure plus investment expenditure plus government expenditure plus net income from abroad. These two, if you add it together, I give you net income from abroad. Please take note, this is an open economy. This is an open what economy. We have an open economy and a closed economy. When we talk about an open economy, we talk about an economy that allows importation and exportation of goods. It's open. They allow import and exportation. It's import of goods and export of goods. But for a closed economy that is closed, there's no importation and exportation. We usually call it the three-sector economy. We have the Y is equal to C plus I plus G. This is a closed what economy. There is no what foreign trade. So a closed economy, there is no foreign trade. But in open economy, there is foreign what trade. Then we have some limitation of the expenditure approach, difficulty in accepting price of certain commodity, and double counting. So today for your assignment, this will be your assignment. Okay, let me summarize before I give you an assignment. So we have all the three approaches of calculating national income. We have the expenditure approach. This is the expenditure approach. We say I deal with consumption of individual, government spending, investment spending, that is spending by business enterprises. We also have what import and what export. They are taken into consideration when calculating the expenditure approach. That's how much we spend on expenditure in exporting goods minus how much we receive for exporting goods minus how much we spend for importing what goods. Then we have the factor income approach, or the factor income approach is the income approach. It's what it simply does is measure what the income received by various factors of what production. Then the value added approach, what it does, it record the what output or the goods produced by the various sectors of the economy. So these are some of the what approaches we use to measure national income of a country, and we have looked at each of them, look at their what limitation. So for your assignment, this is your assignment. The following data relate to a closed economy. When we talk about closed economy, talk about the economy there's no importation and exportation. Okay, of a closed economy of a country where all production take place in two firms. That we have two firms in the country. We have two firm A and firm B. Those are the only two business in the country. Use the information in the table to answer the question that follow. So this is the table, as you can see on your screen. This is the items. This is firm A and this is firm B. So let's look at the questions that follow. Number 1, AI. Which of the items listed above is an intermediate input? So you will go back to the table, look at the item, you tell me which of them is intermediate input. When we talk about intermediate input, we talk about they are like raw why am I will give you the answer? These are used for producing other commodity. B. What happened to input in the calculation? So what happened to intermediate input in calculation of the national income? When calculating the national income, what do we do with intermediate input? Then C. Calculate the gross domestic product of the country, the GDP of the country. We have 3 approaches. We have the income approach, the expenditure approach, the income approach, the expenditure approach, and the output approach. So look at anyone that you want to use and use it to calculate the what? The GDP of that country. B. Calculate the total amount of depreciation of the country. And D. Calculate the net domestic product of the country. Net domestic product is GDP minus what? Depreciation. So that's all for today. Thank you for being part of my class. God bless you and have a nice day. Bye.